This is Eric Mwather with Mwather.com for the week of September the 25th, 2011. Let's take a look at what the week and some of the areas we need to be watching for possible market turnaround to the upside or continued pressure to the downside, which we saw this week. This is a 3-year weekly chart for the Nasdaq, and what we see on this chart is that we definitely found resistance on the market here as far as the 10-week moving averages are concerned. Somewhere around there we found resistance on the moving averages, and those moving averages are the 10, the 13 and the 33-week moving average. So market can't seem to move above those levels. That's bearish. We still have not broken down on the Nasdaq. I would say about scratch that 2341. Somewhere around here is where the Nasdaq needs to break for this to really turn into a cascading action. Some of the markets have already done that, which is part of the confusion. But then again, when is the market never confusing? But this is what it looks like here as far as the Nasdaq is concerned. What we want to, if you're a bear, you'd like the market to break this 2341 level right there. If you're a bull, you want the market to start bouncing and at least challenge these moving averages here, which it stalled this week, good for a 5% drop on the Nasdaq. Now if we take a look at the Nasdaq from a daily chart, you see what we talked about last week during my weekend video. You'll notice here that on this yellow shaded area, which was an area of the market that was support, had been right there, that was support there, 2 occasions, and once we broke down right there, we've worked our way back and we've hit this yellow shaded area twice. Once, the first time we backed off, we came here the conclusion of last week. The market had a nice week last week, but we could not move above that, hence the drop that took place this week, pulling the market good for at least a 5% drop on the Nasdaq. It's because market could not defend this area to the upside. So of course, if you're a bull in this market, if you want to see the market move higher, it has to first and foremost move back above this yellow shaded area. Otherwise, as long as it remains trading below that area and this area here, the threat is always going to be that the market is going to break this August 2011 lows. Remember, other markets have already broken those, and I'll show you in this chart. So these lows of August could be under threat as long as this market in the Nasdaq cannot move back above that yellow shaded area. Now if we take a look at the Dow Daily, and you'll see what happened here is we had a rally here last couple of days, about 4 or 5 days ago, that stalled exactly at the 50-day moving average, which is now declining. Also notice that we have a flattening out 200-day moving average, and one can just speculate that this is also going to move lower over time. And the only way these moving averages can move lower here is by prices continually pressing lower. So that's the scenario right now. Again, on the daily, the Dow did defend, which is very bullish. If you're a bull, you like the fact that the Dow so far this week has defended the daily closing lows of August. That's good. That's where you can build a rally. So right now, one can say going into the weekend, for a one-day rally, which doesn't make a trend, but you can say, there are some signs there that the market is trying to defend the March 2011 lows, and as long as they hold, then one cannot be at fault for trying to play the upside in some stocks here and there. But we'll keep watching, see how this market corresponds and trades in relation to this daily closing low of August. Now, unfortunately for the market, on the weekly time frame, we broke down below the weekly closing price of August. So which means that at the same time, you can't really take comfort from the fact that the Dow held its daily support. The weekly support was broken at 10,817 on the Dow. So and the scenario here is quite very simple. You'd like, if you're a bull, you want the market to recapture this level here, and if you're a bear, you want the market to keep staying below this level. As long as the Dow is below this level, to me, you want to play the downside. In other words, the risk in this market right now is for markets to go lower, and is not, and rallies can be there, but to me the risk, in other words, where you're going to get big point moves, to me still remains to the downside, and that's the same scenario. So the weekly has broken. As long as the Dow is below this level here on a weekly basis, then the bears have the upper hand. Here's an example: the New York Stock Exchange comp. You can see it broke below, it definitely broke below August daily closing lows, and that's why I'm saying once you start seeing some markets breaking down, it does not take much to break other markets. So here we see a huge composite in the New York Stock Exchange, which is broken and still remains below the March daily closing lows, and that's bearish. The S&P 500, on the other hand, on a weekly basis, still defending that 1123 area, which is bullish. You want, if you're a bull, you'd love to see this S&P 500 hold above this level, because this is where, if it breaks below this level here, the 1123.53, then that's gonna be good for another continued move to the downside. So if you're a bull, you can take comfort from the fact that the S&P 500 has yet to break down. If you're a bear, watch this level to see whether the market breaks down below it, and if it does, then you still want to be bearish. The S&P 500 from a daily chart, what I see here is there's the lows of August, about 1100, somewhere there. I think that's the line in the sun. Let's watch that to see how the market, if it goes to that level, how it responds to that. Now it could break and everybody sell, because that's a serious 52-week low. Yeah, that would be a 52-week low in the market. Everybody would get out if this 1100 is broken. Now unfortunately, the way the market plays is you could have a break, shake out everybody out, get all the bears in the market just before they push the market back above this 1100 level. So we have to recognize that 1100 is a low. About 1100 is a low for this year, and if we break those, there's gonna be a magnitude of selling, but that again could also be a trap before they turn the market around and push it higher. So let's watch that, but at the same time, should we challenge 1100 and just keep cascading lower, then you want to stay short, short term. Now this is QQQ, and what you see here is pretty evident. This purple line here is where we broke down below this level here sometime in August, broke down below that line. Over the last couple of weeks, we went back and hit this line twice on 2 weeks in a row, but we've been unable to hold that line. So now we are backing off. In other words, it's a back test, and usually that just means that once you can't recapture that level, then you're going to be seeing lower prices. And like I've been saying, to me the threat in this market has always been to break those August lows. This chart just tends to confirm that, that now we are back testing this line and can't seem to capture that level. I think we move low. Last week talked about the XLF and the fact that if it moved below 12.13, it was reason for you to get out of this market. And as you can see, this week we are on the financial space. XLF is now closing very much below 12.13. Now the only way that you can start buying some of the financials is if the XLF recaptures this level. So this is a line in the sand as far as the financials are concerned. 12.13 on the XLF. Anything, as long as if it remains below that level, it's a sell in the financial space. And if it remains If it remains, but if it recaptures the 1213 level, then you want to be bullish.